I ran a screener on over 3,000 stocks to find the dividend aristocrats of tomorrow. I ignored the 50-year streaks and focused on just two things: quality and dividend growth. And today, I'll explain why famous names like Domino's or Broadcom didn't make the list to make room for 9 high-quality businesses with great fundamentals, double-digit dividend growth, and a dividend growth streak that puts them in a prime position to become the dividend aristocrats of 2035. And if you're new here, my name is Florian and I'm a physics engineer from Germany with a passion for data-driven and objective investing. Welcome to the channel and thank you for joining me today. Most dividend investors are looking at the wrong numbers. They are obsessed with yield or the growth streak. 25 years, 50 years, the dividend aristocrats and the kings. But a long streak isn't always a badge of quality. It can also be a warning sign, because it tells you that a company is mature, slow, and maybe even struggling to find anything better to do with its cash than to hand it back to investors. And because of this, the dividend aristocrats have been underperforming the broader market, as we can see here in the 10-year comparison of the S&P 500 Dividend Aristocrats ETF in purple against the regular S&P 500 in orange. And I mean, think about it. To maintain a multi-decade dividend streak, management has to prioritize that payout over almost everything else. R&D, acquisitions, even the balance sheet can take a backseat. You basically end up with zombie aristocrats. Businesses that keep their streak alive until they can't afford it anymore. But today, we aren't looking for the survivors. We are looking for the future compounders. According to research, the best performing stocks in the last 50 years were the ones that were growing the dividends. These companies produced the biggest returns while at the same time having the lowest volatility. And to find the best dividend growth stocks that could be the contenders for the next era of dividend aristocrats, I ran a screener on over 3,000 companies. For this, I used Seeking Alpha to first eliminate all companies with a market cap of under 2 billion and a yield of under 5%. After all, we are looking for companies that can pay a meaningful dividend in the future. Next, I selected companies that had over 7% dividend growth in the last 5 years and over 10% in the last 3 years, because I want to have companies that have picked up speed with the dividend growth. And if we want to have dividend aristocrats in the next 10 to 15-ish years, they need to have grown the dividends for 10 to 17 years already today. Then I also eliminated companies with very expensive valuations and with negative growth. My requirements for growth here are not very strict, I just want to see some positive growth for them. In the end, this gave me a list of 26 companies that I then sorted for the highest dividend growth. But I was not quite done yet, because I didn't just use the top 9 companies from this list. I went ahead and checked each of these companies for red flags. And by doing this, I also had to eliminate some pretty famous dividend stocks. The first one was Domino's Pizza. They had a great run until 2022 and have been a massive compounder. But look at the balance sheet. They have been using debt to fuel buybacks and dividend for years and are sitting on a net debt to EBITDA ratio for over 4 times and an interest coverage ratio of under 5. In the current high interest environment, that's a risk I'm not willing to take for a long-term dividend growth play. 2 other honorable mentions are ALG or Alamo Group that I eliminated because of the low return of invested capital. This is even below their weighted average cost of capital. This essentially means that they are even destroying value right now. And if a business isn't efficient at turning capital into profit, I don't trust them to sustain a high dividend growth without taking on debt. Finally, I also eliminated Broadcom. This is a great company, but at the current high valuations, you are buying a momentum stock. And for my list, I just wanted to have a reasonable price. Now, don't get me wrong. These aren't bad companies. Each of them is a powerhouse on its own, but they just don't fit the future dividend aristocrats archetype that we are building today. The 9 companies that survived, however, have balance sheets like fortresses and highly efficient business models. And let's start with our first 2 companies that are operating in high barrier medical niches. First up is Lemaitre Vascular, and sorry if I butcher this name. This is also the smallest company on our list with a market cap of 2.6 billion. But on a fundamental basis, they might be one of the strongest. They specialize in niche devices for vascular surgery. Things like car toy chunks and patches that you can see here. These are products that a surgeon must have, but that are too small for giants like Medtronic to care about. Over the last 5 years, they have outperformed the S&P by around 40%. They even have a negative net debt to EBITDA ratio of -2.2. So they have significantly more cash than debt. And while other companies use leverage to juice up their dividends, Lemaitre is paying you out of pure hard cash. Their ROIC sits at 10.5%, which is solid, but what really stands out here is that they could increase their margins, especially the EBITDA and free cash flow margin, steadily over the last years. And a free cash flow margin of just shy of 30% is indeed pretty impressive. Overall, they get a 10-year health score of 8 in my stock scoring system, which makes them a sleep well at night pick. Their dividend score is also a very good 7.8. Overall, they get a 10-year score of 7.1. And this puts them in the 7th spot of our companies today. But their smallish size also brings the risk of higher volatility, and their price is far from cheap, even though they just barely managed to squeeze through my filter. That could also be the reason why insiders are selling a lot of shares recently. So it might be worth to wait for a better entry point, but it is still a very high quality business. Our second company is Zoetis. They didn't have such a great performance in the last 5 years and went pretty much sideways since 2023, underperforming the S&P. Most people hear healthcare and immediately think of Pfizer or Johnson & Johnson. But Zoetis, which actually spun off from Pfizer in 2013, is the undisputed king of a much better business: animal health. They develop and manufacture vaccines, medicines, and diagnostics for both pets and livestock. If your dog gets a shot or your local cattle rancher needs to prevent an outbreak in his herd, there is a good chance that Zoetis provides the solution. And the secular tailwinds here are incredible. As just 2 examples, we have the humanization of pets and the growing global protein demand here. But the real kicker for dividend investors is that unlike human farmers' patent cliffs, where the revenue can drop 90% overnight, Zoetis in animal health maintains their revenue. This is due to the high brand loyalty, which limits the impact of generics, and the lack of government price caps since vet bills are paid out of pocket. And the numbers back this up. A 23.5 ROIC and increasing margins show their strong business model. In my scoring, they get a 10-year dividend score of 8.3, one of the highest in my entire database. One reason for this is the insane dividend growth of nearly 20% annually for a decade. And they still only pay out about 39% of their free cash flow. So they still have a lot of room for further growth. Overall, Zoetis gets a score of 7.5, which puts them on the 3rd spot in my list. A noteworthy risk for Zoetis is that they have currently a big lawsuit in the US running that claims that Zoetis failed to warn consumers and vets about the potential dangers of Librela and Solensia, 2 arthritis medications. Now, if you want to find the most consistent dividend growth in the market, you have to embrace the boring. That's why my second category is the industrial compounders. These aren't flashy software companies, but their fundamentals would make most Silicon Valley CEOs jealous. And leading the pack is Amphenol, a company so boring they don't even provide a proper company presentation. But they had an amazing run recently and outperformed the market by over 4 times over the last 5 years. They don't build the chips or the screens. They make the sensors, antennas, and connectors that allow all these components to talk to each other. So every time a car gets an extra camera or a data center adds a rack, Amphenol wins. It's a massive security play on electrification and data centers. And just look at their dividend score. They get a 7.8 here with one of the highest 5-year dividend CAGRs from all companies that I ever analyzed. A whopping 25%. They also have an ROIC of 19, which they could grow from around 16 in 2023 while keeping the debt at a minimum. Just 0.67 times the EBITDA. This also comes from the massive secular tailwinds that they have that are also visible in the numbers from last year. And there is currently no end in sight, and the growth forecast for the next years is well over 20% for EPS and revenue. Overall, this gives them a score of 7.3 and earns them the 6th spot on our list today. The biggest drawback for them is again the high valuation. Now, they also did manage to barely make it through my filter for forward-looking valuations, but they are definitely on the more expensive side. Our next company is Lennox International. Their 5-year performance is basically on par with the S&P 500. Sometimes they are a bit ahead, but right now they are a bit behind. Not a big difference though. They are a global leader in energy-efficient climate control and are specializing in HVAC-R, heating, ventilation, air conditioning and refrigeration. Now, if you think that this is a cyclical construction play, you're missing the point. Because Lennox isn't just about new buildings. It's about the replacement cycle that makes 80% of their revenue. Because when your HC dies in July, you aren't waiting for a better macro environment to fix it. You are buying a new unit immediately. And that gives Lennox an incredible pricing power. Their ROIC is a staggering 35.4. This is pretty elite for a company that makes heavy machinery. It's almost double what most tech companies produce. Their overall dividend score in my rating is also an 8.2, which is pretty good. In our overall ranking though, they are in the last spot with an overall score of only 6.2. The whole HVAC industry in the US is also just shifting to a new refrigerant, which just saw a huge price spike of around 300% because of shortages on the market. And because these new systems are more expensive and complex than the older ones, Lennox customers are choosing to pay for expensive repairs rather than for new models, which directly eats into their high-margin residential business. So this is something to look out for. Finally, our last industrial company is Snap-on. Same as Lennox, their 5-year performance is also roughly on par with the S&P. Snap-on is the ultimate brand mode play. If you walk into a professional auto shop or maintenance hangar for planes, the technicians aren't using tools from a retailer. They are using Snap-on. They are a global provider of premium tools and equipment for professional technicians. They are well known for their mobile van, which brings their high-end products directly to the workshops, which creates a unique and loyal customer relationship. And once a mechanic invests $20,000 in a Snap-on tool chest, they aren't switching to a competitor. Snap-on is also one of the few industrials with negative debt. They are literally sitting on more cash than long-term debt. And even though they are not growing as quickly as some others on the list, they could still grow steadily over decades already. And the same is true for their margins. It is pretty rare to see a hardware company that can grow their margins so steadily over such a long time. Their dividend score is a massive 8.5. The highest in the group, mostly because they also have the highest yield with 2.6% right now. But overall, their slower growth and higher cyclicality of the business is just enough for the 8th place, just ahead of Lennox, with a total score of 6.7. The biggest risk for them is a shortfall of skilled technicians, which directly impacts their total addressable market. The biggest end market, the automotive market, is also experiencing a big shift to autonomous driving vehicles. This might not be a problem, but it is a risk. And higher automation for maintenance and repair tasks with robots, for example, would definitely have a huge impact on them. Next come two companies that are pretty close to a perfect business, but that are still no dividend aristocrats. The two global transaction toll booths, Visa and MasterCard. If you don't know these two companies yet, you are probably new to dividend growth investing or you have been living under a rock. And because these are pretty well known and I covered both of them on the channel before, I'll keep this one short. Visa had some tough times recently and fell a bit behind the general market in terms of total performance in the last 12 months. And for MasterCard, the picture looks pretty much the same. Contrary to what many believe, these are not finance stocks. They don't lend money. They don't take credit risk. They don't care if you pay your bills late. They are technology companies that own the global money transaction infrastructure and earn a fee every time money is transferred. And this business is booming and growing quickly. We see the same trend for Visa as well as MasterCard, with MasterCard even growing slightly quicker. Both of them also have a close to perfect health and profitability score in my rating of 9.8 for 10 years. The only points missing for both is the net debt to EBITDA ratio. And that is only missing points because it's not negative. And look at the ROICs. Visa has a 33.4 and MasterCard even an unbelievable 58% here. For context, everything above 15% is considered high quality. So these two are operating on a whole different level. And because the networks are already built, every transaction essentially costs them nothing. This is also why the margins are so high and, for MasterCard, even still growing. But we are here for the dividends today, and both of them have streaks that put them right in the sweet spot of a peak dividend growth. 17 years for Visa and 10 for MasterCard. Their free cash flow payout ratio is also still pretty low, only 14% for MasterCard and 36% for Visa. Overall, Visa gets the slightly better score because of the longer streak and higher 5-year dividend growth. But MasterCard wins the overall score by a tiny bit because of its higher growth. Still, these two compounders are on spot 1 and 2 in our ranking today. But even though both of them are very high quality companies, they don't come without risks. Some risks include the rise of stablecoins as transporter payments or the rise of AI agents. I talked about all of these risks in more detail in a recent video about Visa. The link is down in the description if you want to check it out. But before we come to our last category now, if you like this kind of data-driven analysis and think it helps for your own investment, please hit the like and the subscribe button to not miss my next one. As a small channel, every single like and subscribe goes a long way to show the YouTube algorithm that this is a video worth watching. So thank you very much. Now, we have looked at healthcare companies, industrial compounders, and our 2 global toll booths. Now we are moving into the ecosystem providers. Companies that provide the digital scaffolding for entire industries. And first, let's talk about MSCI. If you ever bought an emerging markets ETF or the famous MSCI World Index Fund, you are an indirect customer of this company. But they don't manage your money. They provide the intellectual property, the indices that the money follows. But same as our other 2 financial infrastructure provider, they also had a tough time and their performance was flat over the last 2 years. But the business is still one of the stickiest on earth. Because if an asset manager has 100 billion benchmarked to an MSCI index, they can't just switch to a different provider to save a few basis points. So the switching costs are massive. This also gives MSCI incredible pricing power and a recurring revenue stream that is essentially a tax on the global investment industry and makes up 98% of their overall revenue. This business is just beautiful. MSCI has a 33% and still growing ROIC, high margins that are still getting higher, and an insane free cash flow growth. They aren't just growing, they are compounding at a massive rate. Every single income metrics here shows a stable double-digit growth over the last 5 and also over the last 10 years. And even though the valuation is also far from cheap, it is still on the lower end of the 5-year range and well below the 5-year averages. Now, last but not least, there is Intuit. You might know them for TurboTax, Credit Karma, or QuickBooks. But you should rather think of them as the operating system for small businesses. Once a small business owner sets up the payroll, the invoicing, or the inventory on QuickBooks, they are locked in. Moving the data is a nightmare, so the switching costs are pretty high. They also had a pretty good run until the SaaSpocalypse hit earlier this year when their stock crashed by over 40%. Same as many other software or SaaS companies. But the fundamental picture that we have is similar to what we already had a couple of times today. Intuit's growth is remarkably stable and quick. We are talking about high double-digit growth rates in the 20-ish area per year over the last 10 years. And they also have a very good balance sheet with a net debt to EBITDA ratio of just 0.62, high interest coverage ratio, and pretty good margins. Their 10-year dividend score in my rating is a 8.1 with high growth, a low free cash flow payout ratio, and a dividend growth streak of 14 years already. In our ranking, this puts Intuit even above MSCI with a total score of 7.5 versus MSCI's 7.4. Not a big difference, but still. But of course, there are again some risks. For MSCI, it's their ESG and climate segment that is slowing down as investors are increasingly showing some ESG fatigue. And with over 1/4 of their revenue tied to asset-based fees, a market correction would immediately hit their bottom line. For Intuit, the biggest risk is on legislation level. Because if the government would provide an official tax filing option for free, which was already in discussion in the past, it would maybe not destroy the business model of Intuit, but it would hit their margins. Another risk is that AI agents might be able to do the taxes in the near future and eliminate the need for expensive tools like QuickBooks or TurboTax completely. So now we've put over 3,000 stocks to the test, and these are the 9 that survived. 7 of them even get a score of over 7 in my stock scoring system, which is indeed pretty good. But the lesson today for fundamental investors is simple. Stop chasing the 50-year streaks that are running out of steam. Instead, focus on the compounders that are in their prime. Look for a low or negative net debt, high ROIC, high free cash flow growth, and a sticky business model with moat. If you build a portfolio around these metrics, you don't need to hope for a dividend hike. The economics of the business will practically demand it. But as always, that's just my opinion. Now, do you agree with the list, or do you have any other companies that should absolutely be part of it? Let me know down in the comments. And guys, if you want to know why a small Canadian oil company is smashing the huge oil giants from the US, watch this video next. And as always, this is no financial advice. So please, before investing, do your own research and only use this video as a starting point for your own analysis, especially since today is only a pretty rough look at any of these companies and not a deep dive. That being said, thank you so much for watching, guys, and see you in the next video.